Hey everyone, the trading world is often clouded with noise and scattered insights, making it difficult to follow a solid strategy and generate steady profits from the markets. That's why we're introducing a complete smart money trading blueprint that walks you through the process step by step, from start to finish. In this video, we'll start by showing you how to apply smart money concepts step by step on the chart to build a solid overall analysis. Next, we'll guide you through our trade setup, highlighting precise entry and exit levels. Finally, we'll share our backtesting outcomes, giving you factual proof of how this strategy has performed historically. So if that's something you're into, go ahead and hit the like button to support the content, and don't forget to subscribe if you're new here. Welcome back, everyone. Let's dive in. Now, there are a few essential concepts in the smart money trading plan that you need to practice on the charts before fully understanding the strategy I'm about to outline. First up is market structure and direction. This focuses on identifying key structural levels on the chart and classifying the market as bullish, bearish, or neutral. Next, we move to optimal trading zones and order blocks. These are key areas on the chart that could offer high probability trade setups. Then we have liquidity concepts. Liquidity is the driving force of all markets, and recognizing areas where positions may be liquidated helps us avoid unexpected drawdowns. Finally, we get into entry setups and trade management. Once favorable criteria are met and the valid entry is found, we execute trades with defined order details. Managing open trades means observing ongoing market behavior and adjusting for better outcomes. If you're just starting out and not familiar with these terms, we recommend checking out our earlier videos for a clearer understanding. Let's now break down the strategy. This trading plan operates across two core timeframes. First, we have the higher timeframe where we'll conduct most of our overall analysis. Here, we'll evaluate the market structure to determine direction, spot key levels, identify fair value gaps, recognize liquidity zones, and, most importantly, locate optimal trading areas for potential setups. Next, we'll move into the lower timeframe to confirm trades and identify entries. This plan is flexible and not restricted to specific charts or timeframes. However, your entry timeframe should always be 2 levels below your higher analysis timeframe. In this video, we'll use 2 timeframe combinations only. If we analyze the market structure and trading zones on the 4-hour chart, then we'll look for entry signals on the 15-minute chart. Likewise, if our higher time frame is 1 hour, we'll zoom into the 5-minute chart for trade execution. I've simplified this plan into 5 clear steps. After we go over each one, I'll show you the entry models to help you see exactly how the strategy works in practice. If you don't grasp all 5 steps right away, don't worry, we'll go in depth with multiple real chart examples. At the end, I'll present the backtesting results to give you solid proof of how well this method has performed historically. So, let's begin with step 1, breaking down the market structure. In this general analysis, we apply smart money concepts to identify the market's direction and major structural zones. We classify markets into 3 directional types: bullish, bearish, and range-bound. We start with an uptrend in motion, where the price keeps forming higher highs and higher lows, breaking market structure to the upside. In such cases, we aim to trade in alignment with the prevailing uptrend, as it generally improves the probability of success. This upward move continues until we encounter a change of character, a signal for a potential trend reversal. A change of character is confirmed when the price breaks and closes below the lowest swing low formed between 2 successive highs. Next, we have a downward trend, where the market consistently creates lower lows and lower highs, breaking structure to the downside. Just like with uptrends, we want to stay in sync with the dominant downtrend until a change of character is observed. Once this happens, market sentiment tends to shift bullish. We also encounter directionless or ranging markets, which appear when neither supply nor demand is strong enough to drive price in a clear direction. When we see repeated changes of character in opposing directions and can't confirm a steady trend, we label it as a directionless market. This trading plan is based on a trend continuation model, so it's crucial to apply it only when a clear directional bias is evident in the price movement. Here we have GBP, JPY on the 4-hour chart. Let's apply the first step to determine the directional bias and mark out the key zones. The price action clearly shows a sustained uptrend, with consecutive higher highs and higher lows, consistently breaking structure to the upside. The prevailing sentiment is bullish, so we will only consider long trade setups. These two recent peaks represent consecutive highs, so the lowest point during the pullback is defined as our swing low. As long as the price holds above this level, we consider the overall trend as bullish. Another important level is the latest high, which we will treat as our higher time frame target zone. Let's now observe how the price unfolds. The market broke the previous structure and printed a new high, but there was minimal upward momentum. Notice the repeated rejections, signaling a significant loss of buying pressure. Shortly after, we get a break and close beneath our defined swing low, confirming a valid change of character. At this point, we no longer classify this market as being in an uptrend. What we now wait for is a clear sequence of 3 consecutive bearish moves, a 1, 2, and 3 push to the downside, to establish a downtrend. Once confirmed, we map out the nearest key zones and begin looking for short opportunities. Let's now move into the second step, the core principles behind smart money trading. In this phase, we pinpoint fair value gaps, liquidity zones, and ideal trade areas on the higher time frame. A fair value gap is defined by a 3-candle sequence showing a visible void between the wicks of the first and last candles, with no overlap in between. These imbalances form when aggressive buying or selling dominates, causing rapid price displacement. Typically, the market revisits these gaps to complete unfilled orders and re-establish balance. If sufficient liquidity exists, the market is likely to resume in its primary direction. Liquidity powers the entire market. Liquidity zones are areas where retail participants commonly take positions and place their stop-loss orders. To keep things simple, we focus on equal highs, equal lows, and major swing points. When price collects liquidity from these zones, trade setups often carry a higher probability of success. Optimal trading zones are areas where multiple high-probability smart money concepts converge, like valid order blocks and strong order flow levels. When these align, they become excellent zones to seek trade entries. Let's now demonstrate the second step with a live chart. On the EUR4 United States dollars hour timeframe, we see a clear bearish trend in play. Several notable fair value gaps have recently formed. If price returns to fill those imbalances and then resumes the downtrend, that becomes an excellent short opportunity. Now, let's identify the liquidity pool. That prior swing low level is a key area. If price pulls back to this zone, the old support becomes potential resistance, inviting short entries from traditional retail traders. Most will place their stops just above the level, which builds a liquidity pocket right above. This setup gives institutional players a perfect reason to grab those stop orders before pushing the market lower. That's exactly why we must locate liquidity, or risk becoming it. As for the optimal zone, the candle responsible for the bearish imbalance or the final bullish push before a strong drop is a solid region to anticipate shorts. However, no matter how attractive an entry looks, the market may ignore it and keep running in its current direction. That's why we always wait for lower timeframe confirmation and signs of reversal before entering. Looking at USD, JPY on the 1-hour timeframe, we're clearly in a downtrend, so let's apply step 2 by identifying the fair value gaps, liquidity zones, and optimal trading areas. First up, we've spotted a significant fair value gap, so we mark that as a potential mitigation zone. The market has also formed a strong resistance area here, with price rejecting it several times. As a result, we've got liquidity building just above those equal highs, a classic trap zone for stop orders. Now, focusing on the order block, this particular zone aligns with multiple confirmations, making it an ideal area to watch for short setups. It holds strong confluence with our overall bearish bias. That wraps up all the smart money elements we need for this step: fair value gaps, liquidity targets, and high probability trade zones. Next, we'll wait for price to revisit and mitigate the fair value gap, and once it does, we'll drop into a lower time frame to seek confirmation and execute the short entry. Now let's move on to step 3, confirmations and entry. In this step, we'll use market structure principles to look for valid entry signals that align with our higher time frame analysis. Once price returns to and mitigates the fair value gap, we shift to the lower time frame and wait for a reversal signal. Specifically, a change of character, CHOCH, that confirms the short-term trend has ended and that price is ready to move in the direction of the higher timeframe bias. Warning: no CHOCH. No trade. Simple. Once we confirm the change of character, we use one of two entry models: Checkmark Model 1, with order block plus fair value gap, FVG. If the CHOCH move creates a valid order block and an FVG, we'll set a buy limit 1 spread above the order block. Place the stop loss just below the swing low. Once price hits a 1 to 2 RR, we move the trade to break even and secure partial profits. If price reaches the higher time frame supply, demand zone, we close the rest. Checkmark Model 2, no order block or FVG present. If there's no clear order block or FVG after the CHOCH, we use the Fibonacci retracement tool from the start to the end of the CHOCH move. Set a buy limit at the midpoint between the 0.618 and 0.786 levels. Place the stop loss just below the swing low. Again, apply the same logic for managing partials and taking full profits. These are the only two confirmation-based entry setups we use. They help us stay consistent and avoid emotional entries. Let's do a quick recap of the trading plan we covered. We work with 2 time frames, a higher time frame for general market analysis and condition assessment, and a lower time frame for finding confirmation and entering trades. This plan isn't limited to specific time frames, but your entry chart must be at least 2 levels lower than your higher time frame. Step 1. Analyze market structure. We start by identifying market direction and key levels using market structure concepts. We look for breaks of structure and changes of character to understand the trend and mark important levels where price could react. For example, if we have a clear uptrend with consecutive higher highs, we trade only long to align with the dominant trend. Key levels here include recent highs, which can act as target zones, and recent higher lows, which, if broken and closed below, signal a possible trend change. Step 2. Apply smart money concepts. Next, we identify fair value gaps, FVGs, liquidity areas, and optimal trading zones on the higher time frame. If price retraces to fill an FVG and grabs liquidity near key levels like equal lows or highs, that's a prime spot to look for high probability trades. Step 3. Confirm and enter the trade. We then zoom into the lower time frame to confirm entries. We wait for a change of character, CHOCH, signaling the short-term trend reversal. There are 2 entry models. If the CHOCH creates a fair value gap and order block, place a buy limit just above the order block. If no FVG is present, use the Fibonacci retracement between 0.618 and 0.786 levels to enter. Stops go below the swing low. Trade management includes scaling out at 1 to 2 risk reward and moving stops to break even. Important notes and checklist. Risk only 2 to 3% of your capital per trade. Have a maximum of 3 open trades at a time. Always backtest this strategy on historical data to build confidence and understand its performance before going live. Backtesting manually can be time-consuming. That's why we use tools like Trader Edge to streamline backtesting and keep track of trades efficiently. When we started backtesting, we randomly selected a period for the EUR/USD pair. To our surprise, the first setups generated a significant profit. Let's walk through the charts step by step and share the thought process behind the backtesting. Starting point, higher time frame analysis, 4 HEUR/USD. On the 4-hour chart, the market had recently broken below a key structure level, signaling a continuation of the downtrend. Since the dominant trend is bearish, our focus is on short opportunities. We spotted fair value gaps near a resistance level. Traditional traders might see this as a prime short zone. A lot of liquidity has accumulated above this level, making it an optimal area to wait for price to fill the gap, grab liquidity, and then look for reversal confirmations on lower time frames before entering shorts. Zooming in, lower time frame confirmation, 15 minutes, switching to the 15-minute chart, we waited for a change of character to confirm the short entry. However, despite the setup, we saw no change of character because of strong bullish pressure. This told us to avoid short trades here. Reassessing market structure, back to 4H chart, back on the 4-hour chart, the price broke above the recent lower high, invalidating the prior downtrend. We also identified a double bottom reversal pattern, with the second leg acting as a liquidity sweep, strongly signaling a shift to bullish market sentiment. There's also a significant fair value gap that could offer a great long entry opportunity. Preparing for the long trade, waiting and confirmation, we patiently waited for price to return to this fair value gap area. Once it did, we zoomed into the 15-minute chart to look for entry confirmations. On the 15-minute time frame, the market formed a clear change of character, confirming that the short-term downtrend ended and price could continue pushing upward. This example shows how following the plan, from higher time frame analysis, identifying smart money concepts, waiting for confirmations on lower time frames, helps filter out bad trades and enter high probability setups. This move created a fair value gap, so we'll apply our first trading model, placing a buy order slightly above the order block with a stop loss just below the recent low. Soon after, the market presented another trading opportunity before triggering the first trade. A new fair value gap and order block formed, giving us reason to place another buy order, without cancelling the initial one. Since market direction remains uncertain, we follow our rules-based strategy. In the best case, one order gets triggered and rides the trend. Worst case, both orders get stopped out. Either way, we stay disciplined. Eventually, the market triggered our second buy order and hit our target, securing a 4% gain, because we risked 2% of capital per trade. Then, we spotted yet another valid order block with a high probability setup. Without cancelling the earlier position, we placed a new long trade. Our first target was 2x the risk, and we monitored the price closely as it moved in our favor. For a higher time frame target, we looked at the close of key bullish candles, which offered reliable zones to aim for. Once the market hit our first target, we moved the stop to break even, ensuring that even if the price reversed, we wouldn't lose on the second trade. As price continued upward, we trailed our stop, placing it just a few pips below each newly formed higher low to lock in more profits. This trade ended up performing incredibly well, delivering strong returns. But here's the real talk. Right finger live trading is a whole different game. You'll be battling your own emotions, doubts, and decision fatigue. That's why backtesting is absolutely essential. It's the smartest way to build confidence, fine-tune your system, and prep for every possible market scenario. Push pin if this video brought you value, smash that like button to show support. And if you're new here, consider subscribing so you don't miss the next breakdown. Bulls, I catch you in the next episode.